So this is from my video on current account and financial account. And so just keep in mind that there's lots of different individuals on each side of this transaction here. So in the US, people are importing goods from Germany, and at the same time, people in Germany are buying assets. They obviously don't have to be the same people. So how is it that this is going to exactly balance? Well, it's the same idea as in any other market that we're studying. How is it that the quantity demanded for apples is exactly equal to the quantity supplied of apples? It's because the price causes that market to go to equilibrium. And in the loanable funds market, it's the interest rate that causes the number of borrowers to equal the number of lenders. And in this case, it's going to be the exchange rate that adjusts. So the price of one currency relative to another. So that's what we're going to look at here. So here we have the exchange rate between euros and dollars. And so it's always going to be a pair of currencies. So it could be dollar yen, dollar euro, whatever. And if we're looking at the market for dollars relative to the euro, then it's always going to be euros per dollar. Because we want, if this price is going up, this is now the price that we're using is this exchange rate. If this price is going up, and we're talking about the market for dollars, then we want this to be a more valuable dollar. Right? Well, if the dollar is going up in value, if it's becoming stronger, then you're able to get more euros for your dollar. So here I just assume that we started at 2 euros per dollar, and then this exchange rate is going up to 3 euros per dollar. So the dollar is getting stronger relative to the euro. In other words, the euro is getting weaker relative to the dollar. So whenever we're in the markets for dollars and the other currency, some foreign currency here, it's always going to be the foreign per domestic. So if we're in the market for that domestic, so if it's per dollar, we're in the market for dollars. Okay, so suppose that there's some good in the US versus some country that's using the euro. Let's just stick with Germany. And it's the same exact good, except in dollars is $10, in euros is 20 euros. And we started with this exchange rate of 2 euros per dollar, let's just assume, just to keep the numbers simple. So if the exchange rate is 2 euros per dollar, then I go to make that exchange. I take my $10, exchange them for 20 euros, and I can go buy that good. Right? So it costs the same whether I'm in dollars or euros, given this particular exchange rate. Right, so now suppose that this exchange rate goes up, and for now it doesn't matter why it's going up, but you can now get more euros for your dollar. So just think about what happens, and we're assuming these prices stay the same. So exchange rate goes up to 3 euros per dollar. I take my $10, and now I can get 30 euros. I can go buy this thing that still costs 20 euros, because I'm going to assume for now that these prices stay the same. The only thing that's changing is this exchange rate. Right? Remember, whenever we're changing things on our graphs, generally we're holding everything else constant. So something has caused this exchange rate to rise. Everything else, including these prices, have stayed the same, which means now I can make that exchange, get more euros. Right? The dollar is stronger against the euro, which means this euro good is now cheaper for me. If I'm coming from dollars, it is now cheaper to buy things in euros. Right? So in this case, we have the dollar has strengthened against the euro. We call that an appreciation of the dollar. The dollar has appreciated, which means the euro has depreciated relative to the dollar. Right? So it's always relative to each other. Dollar's getting stronger relative to the euro. Euro's getting weaker relative to the dollar. Right? So this is an appreciation. So one of the key things that we need to keep in mind is that other things being equal, if your currency depreciates, so in this case the euro is depreciating, the dollar is appreciating, your goods become relatively cheaper. Right? Anyone in dollars now finds that goods priced in euros are now relatively cheaper. Right? Or another way of saying that, just the other way around, here we have dollar appreciation. When your dollar appreciates, when your currency appreciates, your goods are becoming relatively more expensive. So just the flip side of this case, someone in euros thinking about buying something in dollars, well, now it takes more euros to make that conversion. So if I want $10, well, instead of exchanging 20 euros, I have to go exchange 30 euros, right? So those US goods in this case are relatively more expensive to foreigners, in particular to people holding euros, or in other words, foreign goods have become relatively cheaper. In this case, again, that's the example that we used here, right? Goods denominated in euros have become relatively cheaper for the US when that currency appreciates. The dollar is stronger, you can buy more with with your dollar, right? Your dollar is becoming more valuable. So we were just explaining the demand side of this market, right? Demand for dollars. Right? It's just like any other demand curve. When the price of that thing is higher, people want to buy less of it, right? Dollars here are higher in price, and so the quantity demanded for dollars is now lower than before, right? When dollars are cheaper, the quantity demanded is higher. So coming back to the supply side, it's really talking about the same thing, because if you're a seller of dollars, you're buying euros. If you're buying dollars, you're selling euros, because we're just exchanging between these two currencies. So when the dollar is more valuable, you're more likely to want to sell dollars, right? And if I'm selling dollars, the reason I'm selling dollars in this case, since we're in the euro dollar market, that means I'm buying euros, right? Because when the dollar is more, remember, when the dollar is more valuable, when the dollar appreciates, things priced in euros are now relatively cheaper, which means I want to sell dollars and I want to go buy more euros, right? So I'm more likely to sell those dollars, exchange them for euros, since they are now more valuable in terms of that exchange. And it's the same idea on the demand curve. So really, the supply and demand here are kind of telling us the same thing. So on the demand side, when that dollar is more valuable, I'm less likely to want to buy dollars and more likely to want to sell dollars, because I want to go buy something in euros compared to before when the dollar is more valuable. So less demand for dollars, and we're going to put them together in a second, and greater quantity supplied of dollars. Less quantity demanded for dollars. When that exchange rate goes up, greater quantity supplied of dollars.